in the depths of this, quasi recession, we have some of the biggest boom in AI happening that we've ever seen. And every 14 days, it feels like we're doubling our ability to generate things with AI. And we're continually impressed by what that means for companies and startups. And so in my mind, like the pace of innovation is just accelerating. And if you were excited about investing in tech in 2021, you should be doubly as excited about investing in tech today.
All right, guys, bang, bang. I've got Yuri here with me. I thought a great place to start this conversation would be on your background getting into investing. You actually are an engineer by training. And so a lot of engineers, I don't think, have kind of an aspiration to eventually become a full-time investor. But talk a little bit as to maybe the pros and cons of being an engineer turned investor.
Sure. First of all, thanks for having me. I'm excited to share. For me, the story starts like I always wanted to be an engineer. I wanted to be an engineer since I was probably like 6 years old. Not like a real engineer. I wanted to be to build software since I was 6 years old, got my first computer. And so when I was in undergrad, I'd actually started a company. It was like a web hosting company. That was my first foray into entrepreneurship. And when I graduated from undergrad, I was trying to figure out what I wanted to do next. And I knew I didn't want to go work at a big company. I had done an long internship at a very big company, and it just like wasn't for me. And so it felt like a good thing to do would be to go and do grad school. And so I started grad school with, I think, the intention of never really finishing it, but just having some time to think about what I wanted to do next. And so in grad school, I met another PhD student, and he and I started a company together. And when it was just an idea, we decided to apply with it to Y Combinator. And that was back in 2010, and got accepted, moved down to the Bay Area. Throughout none of that, like at any point in time, did I think that like, oh, I'm going to go and become an investor. To me, being an investor meant like public markets investing. I didn't really think of startup investing as a real thing. It just didn't occur to me that it wasn't even a possibility. And so when we moved down here and we started building the business, we obviously raised money. We raised a seed round, an A round, a B round. And along that way, I also got asked to come and help at Y Combinator. And that was my first real introduction to being an investor on the venture side of things. So like I started working at YC in 2014. I worked there for about 5 years. I was a part-time partner for 4 years because I was still running my company full-time. And then after that, after my company got acquired, I actually joined to YC full-time and worked there for another year. And that was, it was just like a fire hose of startups. And you start realizing that, oh, you can actually like write an angel check to the startup. And that was for me like the first taste, I never really thought of myself as even an investor when I was at YC, but it was like the first angel check that I wrote to a company was my introduction to being an investor. And so then when I left YC, I actually spent another year trying to figure out what I wanted to do next. I didn't think I would start a fund. I thought I would start maybe another company or maybe join a VC fund. I spent probably half a year talking to a bunch of VCs and ended up thinking that I like investing, I like seed. I didn't really like the politics of a lot of funds, and ended up deciding that, okay, I'll do my own fund instead.
When you think back to your time at YC, it's interesting. You went through the program and then you saw a bunch of companies go through. And I just think of like practice, right? You probably didn't think of it as practice, but you were practicing, you're developing that pattern recognition. Talk a little bit maybe about some of the things looking back that you noticed in founders that now you have the data points to know who was successful and who maybe wasn't as successful as you thought at the time. Like, are there certain things that you can point to and say, now this is a pattern that I recognize just seeing so many startups go through the program over 5 years?
Yeah, so I think that it's definitely about reps. I think that as an investor, especially at seed, it's all about reps and getting as many practice reps as you can. And the benefit of YC is I think while I was there, we had funded about 1,000 startups. And so you do get to see it at scale. I think that the characteristics about founders that really stand out is just kind of this bias towards action. A lot of founders or a lot of people in general, just, they'll start a project and they'll just never finish it. And honestly, just like finishing a project is one of the, something that will set you apart from a huge number of people. And on the YC application, one of the questions that gets asked of each founder is like, what's something impressive other than the startup that you've actually built? Right. And to me, that question has always been around like, have you actually started and finished something that you're proud of? And so I think that one, like that characteristic is really important. And the way that it shows itself is in velocity, right? Like how quickly are you moving? How quickly are you building stuff? How quickly are you iterating and learning and making mistakes? It's in scrappiness, right? It's like, what are you able to do without any funding, right? Like when I went through YC, we got like $17,000 and it felt like a lot of money. Right now, the program obviously gives you substantially more than that, but the best founders will be able to succeed even if they didn't get that money, right? And they're able to do that because they're usually technical, right? Like the benefit of being a strong technical founder that can actually build things is that you don't need a lot of money. You just need a computer and a Wi-Fi connection. And so those characteristics to me, just like the scrappiness, the velocity, and just like getting things done at a very fast pace are probably the strongest indicators of success in founders.
This brings up a really interesting point, which is I think a lot of investors, especially when I'm talking to these managers and thinking about investing in their funds, I'll say, hey, what is your kind of competitive advantage? How are you going to be able to win access to these deals? And most of them will revert back to like how helpful they'll be. Right. And they'll kind of brag about all the things that they're going to do to help their portfolio companies, which like I do think it's people with good intentions and they want to be able to do that. But in some ways, you're highlighting the fact that like maybe the best companies are the ones who actually don't need any investor help. Like they're going to be successful without funding. They're going to be successful without a bunch of help externally. And so is it something where you want to find the founders who would be successful otherwise, but then you want to be helpful in order to help kind of increase the probability of success?
I think so. I think that those characteristics are true in the sense that like you definitely are looking for founders where you feel like they will succeed whether you're there for them or not. But as an investor, I think it's always a good feeling where you feel that like, they will succeed, but maybe you can help them avoid some mistakes. Mm-hmm. And when I invest in a company, it is a cliche. Every investor says that they try to help. I try to help in a very specific way. I was an engineer that became a founder that had to learn how to sell. And in the early days of being a founder, you usually have to do all the founder sales yourself or the sales yourself in general. And so when I invest in companies, part of what I offer is to do office hours and help when they're going from like 0 to $1 million in ARR, when they're doing the founder selling, when they're coming up with their first pilots, success criteria for those pilots, sales agreements, and all those founders would figure it out anyway. But, if they could figure it out in 18 months and make a bunch of mistakes, and maybe I can help them figure it out in 12 months instead and make a few fewer mistakes, that actually allows them to hit that exponential a little bit sooner. So I would never take the credit for a founder's success. I think that they do that all on their own. But if I can help them just move a little bit in the right direction or avoid a little bit of like a mistake that they would have otherwise made, I think that for me as an investor is a very good feeling.
Talk about the environment at YC while you were there. So one of the aspects that's most fascinating to me is if you take a bunch of ambitious people who are, aspiring to this great level of success, frankly, in some cases, trying to do insane things based on almost any other measurement from somebody outside of the building, and you put them all in that same place. Is there something special about that? Like how much of the success of these companies is literally just being around like other insane, highly driven people. And then that forces you to kind of want to level up your game and really kind of be successful to compete.
I think it's a huge portion of the success. I think it is the disproportionate portion of the success is like putting a bunch of smart people together in the same room. And I think that it manifests itself best because like you could say that, in the beginning, all the YC, like it was a lot about the advice, and the advice is still very, very important. But YC has actually open sourced a ton of that advice. You can go to ycombinator.com, you can go to Startup School, you can go to the YouTube videos. It's all out there. You can consume as much of it as you want. And so in principle, at least, you should be able to go and use all of that advice and build a company. But you still see these like disproportionately successful companies coming out of YC. And the reason in my mind is that you do put smart people together and you do these office hours together. And every single week you show up and you say, what did you get done this week? and nobody wants to show up and say that they didn't do something, right? And so it creates this like high velocity, high pressure environment that's like everyone loves, and it lets you perform at a level that you otherwise probably wouldn't have performed on your own. The other thing that it does is it allows you to use YC as a shield and an excuse from the external world to say that like, hey, for the next 3 to 4 months, I am busy doing this thing. Please don't disturb me unless it's an emergency, right? And so it allows you to really focus in a way where, like, if you're just working on your own and you're working from home and external type, like people are coming in or grabbing your attention, it's very difficult to actually turn them down, because YC kind of gives you this shield, this community shield that says, hey, for the next 3 to 4 months, turn all the distractions off and go and do this thing. And I think it's those things together. It's like the smart people in one room plus the ability to actually turn down the noise for a period of time.
It's interesting that you bring up the fact that YC is open source so much of the advice, right? I think that's a net positive for the startup world, because obviously now all these people get access to that advice and it can help them move the needle on their companies. One of the downsides, though, that I've noticed is like there used to be this pattern recognition of certain ways that people thought or certain things that they would say as you were kind of talking to them to invest in their business. And I've noticed over the years that I call it like a blog post founder. It's like they went and they read all the blog posts and now they're just repeating back the things. But
it's
you
like
almost
the ChatGPT of startup advice.
Yes.
Yeah, or not startup advice, it's the ChatGPT of like startup answers rather.
Yes.
Yeah.
And so in some weird way, you almost have to like kind of have a measurement on like, do they actually believe what they're saying, or are they just regurgitating back what they read in a blog post? And, you know, it doesn't take long to kind of get at the authenticity of it. But I do think that there is not 100% upside. It has made some investors' job a little bit more difficult, because now some people have the right answers, but actually they may not even know what that means in terms of implementing them.
Well, I think that there's truth to it. I think that like people have been trained to talk to investors in a certain way now, and partially it's because of all the videos that people have watched online. But I think the reality is, to your point, that you can go and parse that out pretty quickly. One of my favorite, like I think that you can give all the answers in the world, but like the moment you dig in on a customer question or something else, it all, the truth comes out. And so for me, one of my favorite questions to ask founders is often just like, what's something surprising that you learned from a user, right? And I think that question is really interesting because it probes, like, did you actually talk to any users? It also probes, like, did those users actually try your product? And the reality is that, like, same as with a business plan, like the moment that a user tries your product, they're going to use it in some unexpected way. They're going to do something that you didn't build it for. And your ability to internalize that and see how people are interacting with it will come through in your answer, right? And so you can read all the blog posts in the world about how to talk to an investor, but unless you go and spend time with your customers, you're not going to be able to answer that question very well.
When you see YC companies like, let's take Stripe, they obviously benefited from the fact that they were in a program with a bunch of other potential customers. And so there was like the cross-selling to other YC companies. How much of that do you think YC has been able to figure out? And we'll use YC as an example, but I think there's a ton of accelerators, a ton of these programs now where people who are building developer tools or building, some sort of infrastructure for other companies being put into these programs is not just the advice. It's not just the high tempo. It's also, you're basically getting put side by side with a bunch of potential customers. And if your product's good and you're good at sales, you should come out of there with a lot of revenue as well.
I think it's much more true for companies now than it was when Stripe was going through YC. Stripe went through YC in 2009. And at the time, like immediately after the Stripe batch was my batch, and my batch was 30 companies. So it's not like you were able to really like build to a ton of customers, right? Now, if you're going through YC, you have the historical like 4,000 startups that have gone through the program, plus the like 200 to 300 startups that are going through the program right now, plus the 200 to 300 that are going to go the next 6 months. So there's a lot more of that base. And in fact, when I was there towards 2017, 2018, we had created an event that was almost like a demo day, but instead of investors, we would invite technology buyers. And the cool thing about that environment was that YC at this point has such a massive alumni community. There's something like, I think it's probably 10,000 alumni. And many of them are not even working at their startups. They're working at other companies as technology executives. And so they would come to the room to check out the things that new startups are building. And so that became a really, really powerful tool for startups to go and get early customers. I think that that's helpful, and it's certainly helpful for bootstrapping from 0 to 1. But at the end of the day, you still have to get comfortable doing sales. You still have to get comfortable doing outreach on LinkedIn, or if you're doing product-led growth, doing something on Hacker News or on Twitter or another environment. And so it's definitely helpful in getting some early users, but it's not, I don't think it's like a truly sustainable way to build your business, whether it's at YC or any other accelerator, really.
Talk about the team at YC while you were there. So there's obviously Paul and Jessica, but there's a bunch of other partners, some of them full-time, some of them part-time. We're doing this podcast because I tweeted out and said, who are the best young investors, and PG so kindly tagged you and said, no pressure, but here we go. How much is it the people really driving the organization versus could you swap out people now and it's kind of systematized and it would still be as great as it is?
I don't think it's. I don't think that people are plug and play. I think that people are really important. I think that when I started at YC as a part-time partner in 2014, there were like 10 people there, and obviously the organization now is much bigger. But the heart of that organization is actually remarkably similar. Gary is back and running YC now, and he was there in 2014 when I started. Mike Seibel, who's been at YC, I think, for as long as I was there, is still there. Harj is at YC. And so like a lot of these people who are core at YC are still at YC and still providing feedback to startups. The great thing about it now is that they've actually built out a lot of other groups around this. So it used to be just partners and part-time partners, really, and a few people on legal and finance. But now there's an entire software team that builds tools, not just for YC, but actually for the founders, like tools like Work at a Startup, tools like Bookface that are internal forum, plus deals page, plus a ton of knowledge-based materials and so on that they've built out. And so I think that the organization now and the people there now it's even stronger than it was back then.
Yeah. And then talk about Paul and Jessica specifically in terms of what you've learned from them or kind of what makes them so different in terms of being able to build something like this.
I think that they are probably the most optimistic people I have ever met. You talk to Paul and Jessica and you talk to them, and they kind of, Jessica is like a social radar. She's all about the people, and Paul is very greatly about like the startup. And they're both just like incredible optimists, both about the people and the startup. Like you'll talk to Paul about an idea that you think of as like tiny idea, and he will walk you through how this idea will take over the world. And at the end of that conversation, you're going to believe it as much as he believes it. He's not just like blowing smoke. He really does see the vision of how this company that feels to every other person in the world that might feel like a toy could actually become this massive success. And that is something that I try to internalize to as much as I can. I have sometimes like a bit of more of a pessimistic nature to myself. Like I can see a million ways how something will break. But in venture in particular, that actually doesn't matter, right? It's all about how the thing could work. Like the power law of it means that it could break 99 times out of 100. But the one time that it works, it could be Airbnb. Right. And so being able to see that, I think, is a huge superpower. And I think he probably has that better than any other investor in the world. And that's why he's been so successful. Jessica sees that in people. Like you just can't bullshit her. To your point, like if somebody comes in and like says the answer that they read on a blog post or they've, composed thinking this is how somebody wants to hear it, she will just be able to read right through it. And that is her superpower. And I think between the two of them, they're able to just like choose founders who are super ambitious and are genuine in that ambition, tackling problems that could be absolutely massive problems to solve.
There's a bunch of companies that people now know that you invested in, Flexport, Boom, et cetera. Talk a little bit as to your own evaluation process then. Now you have a fund, right? Now you're kind of doing this as a full-time job. But when you were writing checks for yourself and it was kind of more angel investing, did you just look at a batch and like, who are the craziest people here with the biggest idea? And like, let me go give them money? Or was there some other process?
No, it's funny that you bring those two companies up in particular, because I've been fortunate enough to invest in, I think, almost a dozen unicorns at this point. But those were some of the earliest ones that I did. And they're both very, very memorable for me. Flexport, I had met Ryan. I think he was literally the first person I had ever done office hours with. It was my first, it was winter 2014. He was coming into the YC batch. I was just starting at YC. And I remember doing office hours with him. And at the end of the call, you're just blown away. here's a guy that has built an incredibly successful business before this, a company called the Import Genius that was doing tens of millions of dollars in revenue. And he has a chip on his shoulder that it's not bigger. And he thinks that he can actually build something even more impressive from what he learned while doing Import Genius. And I just remember, like, after that call, I actually texted another YC partner being like, is this, like, am I reading this wrong? And he just like continued to impress. To this day, he continues to impress. I think he's just a relentless founder. Blake at Boom had the same thing, but with that, he's one of the few founders that I've invested in that didn't have domain expertise. And I actually got introduced to him before YC by Sam Altman. And Sam said, hey, you need to talk to this guy. He's building a supersonic jet. And I remember getting on the first call with him and being like, well, like, how are you going to do that? And he says to me, well, I'm a pilot and I'm hugely passionate about airplanes. And like, I've already been talking to all these people. And I thought he was crazy. I thought it was just like the craziest thing I'd heard. I was a pilot. I am a pilot. And like, I couldn't, and I have an engineering background and I've taken some aerospace engineering courses and I still couldn't build a supersonic jet. And so initially I actually passed. And then he came to YC and I followed along with him through YC. And the thing that impressed me about him is he has this tenacity about him where he was able to convince experts to join him on this crazy journey, and like he was able to convince engineers from SpaceX to quit. And he was able to convince engineers from Lockheed to quit. And he was able to convince Richard Branson to donate resources from Virgin America, which was an aerospace company, to actually help him. And so in my mind, it went from a question of, okay, well, you probably don't have the expertise personally to build this jet, but you have this ability to recruit people around you who believe in this vision as much as you do, that there is a non-zero probability that you actually could build this jet. And if that's true, then that opportunity is massive. Right. And so I had invested a little bit after YC Demo Day, still kind of at the seed round. I could have invested even earlier. But at that point, I was convinced that like he will be able to recruit the people. And, now he's recruited somebody that was a chief engineer at Gulfstream for 30 years. Right. And so like there's a real team in place that has a non-zero, like a pretty good chance at actually building a jet here.
So unpack.
So it ultimately is like, sorry, just to finish the thought, it's just like, it ultimately is all about the people in both cases.
Unpack this a little bit more. Like, was he able to convince people because the idea was so big? Like, what do you think was so convincing to get all of these really impressive people to leave their companies to come and work on what, you at initial thought was like, this is insane. There's no way they can do this.
Well, I think that it wasn't like, people have built a supersonic jet before. And so that in itself wasn't insane, but it's, he approached it from first principles and he said, well, there isn't like one 10x thing that we can do better today than we weren't able to do with the Concorde. But there's a lot of these like 30% improvements. We have better wing composites. We have better fuel efficiencies. We have better engines. We have better fuel sources or cheaper fuel sources. And together we can put all of these things together and build a supersonic jet that's maybe like 3 times as affordable or 4 times as affordable as a Concorde. And I think that when he went to people, a lot of these people who are working at Lockheed or at Boeing, they're working on tiny projects that take decades to build. And honestly, like a lot of these companies have lost some of their ambition. Like if you look at what Lockheed used to do, if you read Skunk Works, and you see the SR-71 or you see the U-2 or you see the stealth fighters, and then you see like the stuff that they're doing today, it's not as exciting. And I think if you're an ambitious engineer, you want to go and work on something that even if it doesn't work, you're going to feel like you've moved the needle. And so I think that, when you run into someone who's that ambitious and is so genuine in that ambition, you just want to join them on the journey and say, screw it, let's go and try and see. And maybe we succeed and maybe we fail, but at least we'll have tried. Right.
You went into YC in 2010, which is kind of right during that global financial crisis coming out of it. You then were in and around YC and early stage investing all through kind of the decade-long bull market. You then lived through the craziness of COVID and the
Right.
1 month recession that we had then. Then again, here we go
Yeah.
up again in another kind of crazy bull market with all the quantitative easing. And then obviously 2022, we get this big crash in public markets and asset prices. And so whether you count that as like one cycle, two cycles, however you want to think about it, you've seen ups and downs now in early stage markets. How do you evaluate where we are now? Are you looking at this as we're still in some sort of compression type phase? Maybe seed was more insulated from compression versus like other parts of the market. Just talk to me about like the market conditions in early stage investing.
Yeah, I think that, I mean, the bull market that happened in 2020 is certainly an anomaly, right? And I think that it led to and maybe it was kind of the tail end of a long bull market where interest rates weren't zero, but they were low. And so the behavior was starting to get ingrained in people. The valuations were already creeping up. And then everything that happened in 2020 just like completely blew it up. And so in my mind, that correction always had to happen. The one thing that I feel fortunate about is I never really got caught up in the hype of everything is going to be a $15 billion company. And so entry valuations don't matter. And so I tried to continue to be a little bit diligent about how I'm approaching investments from first principles and like, do the valuations matter? How big are these opportunities? What does it mean? Like to be a $10 billion company, you probably have to be at about $1 billion in revenue. What does that mean, right? Like, what does that look like? And I think that today we're starting to come back to that first principle thinking where people are saying, okay, you want to build $1 billion business. That means you need to do $100 million in revenue. How much of the market do you have to capture to do $100 million in revenue? And what does that mean for your entry valuation today? And so I think that correction had to happen. I think that it happened fastest at the latest stages at the public markets, right? Investors immediately retreated the moment interest rates started rising and they could park their money somewhere else. And it slowly trickles down backwards. And so you saw, I think that the late stage markets, private markets are frozen. The Series B and C markets, which are kind of mid stage, are pretty frozen. And the Series A markets are happening, but in fits and starts. At seed, I think that, it took a longer time to correct. People took a longer time to absorb it. And part of me feels like the real correction may have still not happened because I think that there's a lot of these large unicorn companies that are unfortunately going to end up either getting washed out or recapped. And a lot of early stage investors haven't, they might have these funds that have been marked up to 5x and 6x, and they just haven't actually marked them down to see what that performance looks like, and that then realize like what does that mean for their investments going forward. But you do see, I think in 2022 at the top of it, you would see seed investments happening at like $50 to $100 million valuations. So it's just wild with zero revenue. And in some cases, just a deck. I think that pretty quickly reset back to 20, and then you see it resetting back to 15. And I'm now once again seeing things happening kind of in the 8 to 12 range, which is, I think, as a valuation, post-money valuation range is a much healthier valuation range for companies. And so I think that where we are now from a valuation perspective is much better. From a general seed investment perspective, I personally am as bullish on the market now, on the seed market now, as I was in 2022 and 2021. I think that technology is one of those secular trends. It just doesn't care about what the interest rate environment looks like. In the depths of this quasi recession, we have some of the biggest boom in AI happening that we've ever seen. And every 14 days, it feels like we're doubling our ability to generate things with AI. And we're continually impressed by what that means for companies and startups. And so in my mind, like the pace of innovation is just accelerating. And if you were excited about investing in tech in 2021, you should be doubly as excited about investing in tech today.
When you say that the valuations are healthier in kind of that 8 to 12 range, talk a little bit about maybe from the founder's perspective, right? Many founders will hear it sounds amazing to raise money at a $50 million post money off a deck. But maybe talk a little bit about the perils of doing so. And for those that haven't seen kind of the downsides, why is having that healthy early stage valuation so important to the success of a company?
I think there's a couple of reasons why there's a couple of reasons why an early stage valuation actually matters. The first reason is that if you raise at a very high valuation, you now have very high expectations. So for the founders that raised at $50 million valuations for the seed rounds, right, the expectation for their next round, their investors want to see a double or a triple on that valuation. So they're expecting them to go raise at 100 to 150. That might be off the table. But even to raise at 50 now might be off the table, because to raise at 50, the new investors are going to want to see maybe like 2.5, 3, maybe $5 million in revenue, right? And it's very likely that if you raised, 18 to 24 months ago, you're not at $3 to $5 million in revenue today. And if you're not at 3 to 5 million in revenue today, you now need to do a bridge, or you might need to do something that looks like a down round. And so now you're killing morale for your investors, you're killing morale for your team, and you're killing morale for yourself, right? You could have done the exact same round at a $20 million valuation and probably hit the exact same milestones. There's this weird thing that happens when you raise money is it tends to get spent. And it's kind of irrelevant whether you've raised $1 million, 2 million, 5 million, or 10 million. You usually end up spending it in around 18 to 24 months. And I think that when you're raising money, you raise like 10 million on 50, and all you have to show for it is $3 to $4 million in revenue. It just makes your life significantly harder. You could have done the exact same thing where you would have raised 2 million on 12 or 2 million on 15, probably been scrappier, probably hit very similar milestones still, and maybe even have been a little bit more focused because you had less money. Right. And now your next round, maybe it won't be at 150, but you have room to go to 30 or 40. Whereas if you had raised at 50, going to 30 or 40 feels like a loss, not like a win. Right. And so you kind of end up with these two situations where it's hard to get an up round. It's hard to get a flat round. It's hard to get a down round. Nobody wants to come in as an investor, as a later stage investor. You don't really want to come in and price it lower. Nobody will be mad at you if you pass on investing, but people will be mad at you if you actually lower the valuation. And for investors who all co-invest together over a long period of time, that actually becomes something that they think about, right? It's just like the relationship down the road, not just with that company, but with the other investors on the cap table. And so I think that those high valuations do cause problems in those cases. Some of the companies will grow into it, right? Like there's a number of companies that raised $100 million at like $2 billion valuation in 2022, and they have 5 years of runway, and they will grow into those valuations. I think that's totally fine. But the risky ones are the ones that raise like 5 million at 40 or 50 and spent it all and now need their next round of funding.
Talk about those long-term relationships. Obviously, organizations like YC have been around for a long time. There's a partnership. There's something that is pulling people kind of together. There's a brand. When you go out on your own, now all of a sudden it's more like personal relationships, right? There's no kind of early stage mafia, for example. It's kind of a bunch of people who are unilaterally working to invest and find deals, but you most likely are not going to take down an entire round, right? You're not going to go and kind of do it yourself. You need other investors, both as peers in the early stage, but also you need other investors who are going to come in for the Series A or Series B and kind of continue to fund the company. And so how do you think about those relationships and maybe some things that you do to help cultivate the relationships, but then also some things that you look for where you say, hey, this person may be a nice person, but I might not want to actually invest with them in the future?
Well, I think that like those relationships matter whether you're a solo GP or you're a part of a larger organization. So like, a lot of Series A funds don't do Series Bs. And so they'll have relationships with funds that do Series Bs. And those funds know that if they come in and, blow up a cap table of a Series A investor's company, that Series A investor may not send another company their way because they're not going to want to do that. And so I think that those relationships, they span many, many years, and it is at the end of the day a human business. You work with people that you like to work with, and so if you do a deal and then you invite another investor, you don't just think of it as like, oh, I invited this big fund. It's actually I invited this person at this big fund, and here's how they behaved when I invited them. I think that as a solo GP at seed, there are more of these types of relationships that you manage. So because, like you said, I usually don't take down an entire round myself. I will bring other co-investors to the table. There's a long list of investors that I love to work with. Sometimes it's bigger funds. Sometimes it's a bunch of other angels. Sometimes it's other seed funds. that depends more on like what the company needs, right? Like I'll meet a company and I'll feel like, oh, you could really use people with the following expertise. Here's some angels that really have that expertise and have the time to spend with you on this. Or, oh, you really want to have a big seed fund to take down the rest of the round because you want someone who's really committed. Here are some good seed funds that are going to spend time with you that you should talk to. So that roster is pretty deep. But you do remember, like if somebody misbehaves as an investor, and misbehaving is not really about like valuation that they said. Misbehaving is like you broke a term sheet, or you mistreated a company, or you leaked information to a competitor, or you did something else. That stuff gets remembered, right? And you will think twice if you're going to bring that investor again into a deal, or even if you see that investor involved in a deal.
When you look at the companies who have done the best in your portfolio versus the companies who did not succeed, are there things that are either habitual or certain types of decisions early on where you can start to see probabilities changing? Like we talked about individuals being scrappy, having a bias for action, and kind of the velocity at which they made decisions. But what about the companies themselves? Are there certain things that you can see and attribute to, oh, this increases probability of success or this decreases that probability?
I think that it's an interesting question. And I think that it's hard to generalize in terms of like, is there something that really repeats itself? In my mind, the biggest risk to a company is not launching soon enough. And I think that's more of an individual thing than a company thing. But like oftentimes you will convince yourself that the product has to be perfect before launching, and you'll go and spend 2 years, 3 years building it in a vacuum, and maybe with like 1 or 2 beta users, but sometimes not even that. And then you come out and you bring it to market, and it turns out that the market didn't want it. And so building in public, I think, helps alleviate some of that. At least you'll find out very quickly, do people actually want that or not? But I think most of the businesses where things haven't worked out, at the end of the day, they just weren't building something that people wanted. And with startups, it's about finding the answer to that question as quickly as you can. Like, do people actually want what you're building? Mm-hmm. And the ones that have failed, I don't know if it's universally true, but like many of them just didn't launch soon enough, didn't get in front of their customers soon enough, and didn't have the opportunity to pivot or learn from that as if they would if they had done it sooner, right? Because they would have had more runway to go and actually spend the time.
This idea of finding out whether people want your product or not kind of reinforces, earlier you're saying that PG could see something that was small and extrapolate it out and say, this is how it could become very big. We know that many of the most successful tech startups in history have started out either with very small ideas or kind of look like a toy, right? As many people have pointed out. And so Airbnb had, air mattresses in their kitchen. You look at Facebook and it was literally kind of like, is this person attractive or not? How much of the successful companies in your portfolio started out as like this little thing, and then over time they almost kind of got more ambitious, they got bolder, they got more courage to kind of go for a very big company, versus there was master planning and somebody said, hey, you know what, I'm going to go and I'm going to accomplish A. Then they went and started on step one and were able to execute and accomplish that?
I think it's very common. I'd need to go look through the portfolio to figure out like how frequent it really happens. But even like in the case of Flexport, right, the early version of Flexport was not a digital freight forwarder. It was much more like they were digitizing import-export documents, which is something that Ryan had seen when he was doing Import Genius, is that like it was all happening on paper and fax machine. And he felt that alone was a big opportunity. And so he started from that, and now, I mean, their ambitions have grown dramatically, right? And I think you could have looked at Flexport at the time and been like, well, this is like very narrow and not that interesting. But it turned out that honestly, like even if they had just done that, I think that would have been a big opportunity. But they just realized that as they went down that path and they spent more time with their customers, so much more of this freight forwarding world is broken that they were able to continue growing from there. I'll give you another example. One of the companies, this is a very cool company. It's a company called Solugen. This is also an investment before Wayfinder. This is a company that makes carbon negative chemicals, right? And they started here. They had this like little reactor at their YC demo day, which was able to take algae and carbon dioxide and create hydrogen peroxide. So like just a cleaning chemical. And you could have just said, well, like, that's not particularly interesting. There's already a lot of ways to build cleaning chemicals. They had a number of advantages already, but beyond that, they had the aspiration to do much more than just hydrogen peroxide, right? And now they make, I think, almost like a dozen different chemicals, all in these like organic carbon negative ways, where they're actually taking CO2 out of the environment and creating these chemicals. And again, like, I don't think that they would have known in the early days that there was room to like build or which other chemicals that actually be able to do. The only thing they knew for sure is that they were able to make hydrogen peroxide, and they were actually selling that hydrogen peroxide already. And so I think that like with a lot of these companies, and now, by the way, like if you go look them up online, they have this massive bioreactor in Texas, super, super cool. And it's just creating dozens and dozens of chemicals. And so I think that for a lot of businesses, it would start as an idea, or like at least as a wedge, something that's narrow, but has a real problem that you're solving. And ideally, you're solving this problem 10x better than it's already being solved. And then you go and you expand from there. And you go where the customers take you, as opposed to like try and make it up on your own. The customers will usually show you the way in terms of where the opportunity lies over time.
Talk about your relationship with founders and kind of the tempo in which you communicate or kind of help a company. I'm assuming that is much more frequent and kind of much more hands-on in the earliest stages in the seed round or in the pre-seed round. But as a company gets larger, to a Flexport, et cetera, they obviously have many more investors. They have entire teams now. Like that relationship kind of evolves over time. And so maybe talk about the ideal scenario as to like how you as an early stage investor can interact with and communicate early on, and then how do you kind of see that in an ideal manner evolving over that period?
Yeah, that's a great question. So I think that, where I am most valuable to a founder is, again, kind of when they're going from that 0 to $1 million ARR point. And the way that I help there is anything from regular office hours, or even just being available on iMessage or WhatsApp. So every company I invest in gets my phone number. They can text me, they can call me, we can talk about things as they come up. Some companies, every company also gets a private link to my calendar, so we can set up office hours as frequently as they need. Some companies I actually meet with on a regular cadence, maybe once a month or once a quarter, but it's completely up to the founders. It's not something that I dictate. I just say like, look, you can use me in any number of these ways. You tell me how you want to do it. Then the second part of that is just like, well, what do we spend time on? And, I can help you. I can help you with anything that any investor can help you with, but I think where I can uniquely help you is when you're trying to do those first sales agreements, and you're a technical person, but you've never sold to somebody before, and you're trying to navigate that environment, and you're dealing with procurement, and you're closing your first couple of deals. And then even when you're maybe hiring your first account executive or your first salesperson, I've gone on calls and interviewed those people. Eventually, you'll get to a Series A, you'll get a board, you'll get a VP of sales or a director of sales. You won't need me as much. And that's totally fine. I'll still be there if you want to talk about it. And there are still some founders who have raised, even $1 billion valuation rounds and reach out to me to talk about a particular deal or talk about a particular case that's happening with one of their customers or even investors. And I will always pick up the phone. And my goal is to be like one of the fastest responding investors on your cap table. But I usually end up taking more of a back seat after the Series A. The reality is that like when you help a founder in those early days, they tend to remember that. And you remember your first $1 million in sales much more than you remember your next 5 million or your next 10 million. And so I end up being pretty close with most of the portfolio founders that I'm fortunate enough to work with. And it becomes at that point much more of a friendship than just like a pure investor and founder relationship. And so I still talk to them, I still check in, but I try to make sure it's an investor I know has this phrase where it's like, I want to be in your corner, not in your kitchen. And I really think about that, like I don't want to feel like I'm like looking over you and just continually asking how are things going. I just want to help if I can. And if you don't want my help, that's totally cool.
Talk about being kind of a solo capitalist, right? Or an individual investor today. You've got a fund, but you have no partners. I think that you're open to eventually finding a partner if the right person comes across. But what are the pros and cons of operating as an individual investor rather than have kind of the investment committee and a lot of staff and infrastructure and things like that maybe larger funds have?
Right. So even as a solo GP, you do end up having a lot of people helping you. So, I have a fund admin, I have a legal team, I have accountants. There's a lot of people in the back office making sure that the fund is actually working day to day. Where the solo part comes in is on making investment decisions, sourcing companies, and helping the companies down the road. But even that part, I'm fortunate enough that a lot of my LP base are incredibly successful entrepreneurs and founders who are always interested. And part of the reason they're investing with me is that they want to meet other founders and they want to help other founders. They just don't have the time to source the deals themselves. The advantages of being solo is, like you said, I don't have an investment committee. If I meet a founder, I can make a decision incredibly quickly. There's it can be after a phone call or it can be after a couple of phone calls, but I don't need to go and convince the rest of my partnerships. And I think that where this is powerful is most investment decisions are non-consensus. Most of the best investment decisions are non-consensus. They're non-obvious. And if you are spending time trying to convince a partnership, you will lose some of those deals. The downside is that you don't really have someone that's truly aligned with you to try and figure out, should we do this deal, and maybe challenge you in some of that thinking. And so it's up to you to either come up with the reasons, where things may not work, or find people that will help challenge you. And that is also where, I lean on other LPs who are founders and entrepreneurs for feedback. I talk to a number of other GPs where we share deals or we think through deals together. And ultimately, the benefit there is that even if one of us doesn't want to do the deal and the other person wants to do the deal, we're able to do that. And so that helps a fair bit. But I think even in today's environment where deal flow has slowed down, the ability to move quickly and make a decision quickly helps you win deals. And the competitive deals or the best deals still often at times end up being competitive. And so that is a real superpower.
What I find fascinating that maybe many people don't know if they haven't been kind of an early stage investor and focused on it full time is how much of the deal flow comes from other investors versus you went, you were scouring the internet and found some website that no one's ever heard of before and called up the founder,
right.
Or the founder listens to this podcast and is like, oh, let me go email them or track them down. A lot of the deal flow does come from other investors. And so how do you think about signals in terms of deals that other investors are sending to you or talking to you about, and making sure that you actually get a good signal versus maybe this is just an investor who needs to fill out a round and so they're kind of shopping it around to people?
Yeah, I mean, people, you'll end up with a reputation if you do that, right? There is a question of why am I fortunate enough to see this deal, right? That is a question that you always ask yourself. Generally speaking, I'm fortunate enough that most of the investors that send deals my way they are already committing themselves. And they want me in the round because they think I can help a founder with sales or go to market, or they think that that I have a deep understanding of the domain or the space. And so it is true. 99% of my deal flow comes in through a referral, one way or another. It might be through the YC community, it might be through an LP, it might be through another investor that I co-invest with. I think that in my entire history as an investor, I've probably only done maybe 2 deals through cold outreach. And so it's not to say that it's not possible, but it's always a little bit easier to cut through the noise if it's coming in through a warm referral. And it's just a matter of why is this person referring something my way, right? Are they personally excited by this? If sometimes it's not a fit. So I have done deals where a bigger fund is passing, but they think it might be interesting to me. And I know they're not passing because they're not passionate about this, but they're passing because it just doesn't structurally work for them. The check size that's available or something else doesn't structurally work for them. And so in cases like that, I'll still take a look at it. I don't really get, I think that for me, I am fortunate enough that I don't have a lot of those referrals where I'm worried that somebody is just throwing something my way to see if I'll be the greater fool funding it.
It's basically, if you're high quality and you act in a high quality way, then naturally you're going to coalesce with other high quality investors who are acting in a high quality way, right? It's kind of over time, I think there's just this culling of people who don't fit into that mold. And then you eventually just build high trust. I know another thing that you've talked about in terms of high trust, and you mentioned to me earlier, is if you ever were to bring on a partner, and go from one investor to 2 or 3 investors, you actually want high trust with the person, but you want to disagree on almost everything. And so describe a little bit this balance of high disagreeableness with each other, but also the need for trust.
Right. Well, so I think that like if you're bringing on a partner, there's maybe three reasons that you bring on a partner as a VC. One reason is that that partner can bring in additional capital and you're trying to scale your firm and they have contacts that you don't have. Another reason is that they have deal flow that you don't have. So maybe they come from a different community or something else and they're seeing deal flow. And the third reason would be that they can help you make better decisions, right? And that reason is the one where I'm leaning on the fact that like you want someone that you trust, but you don't agree with. Because if you bring on somebody that you trust and you agree with, you're going to make the same decisions that you would have made anyway. So you're not really getting any benefit from having the second or third person on. And what you really want is someone that you believe in, you think incredibly highly of, but they will make decisions that you would not have made because those best deals are the ones that are contentious. And you probably, like they're not contentious and not consensus. And so that means that you're going to give the keys to the money that LPs have entrusted you with to somebody else. And that person is going to write checks where in your bones, you might be afraid that like this deal is not going to work because of whatever reason, but you trust this person and you trust that they have a vision here that you're just missing. Right. And even like in those cases, you probably want to be aligned on the people. So you want to say that, we're going to invest in high quality people where they're high integrity and like all of these characteristics are met. But maybe we invest in the different sectors and like this person looks at biotech, which I don't understand, or they look at fintech and they have a very specific angle on fintech. And so they might do something that I otherwise would not have done. And so that's kind of like the ideal person that you want, right? Like they are aligned with you on values, but they will do things or look at spaces where like you don't know or you don't have personal conviction in. And that's very difficult. Like it ideally is going to be someone that you've done deals with before, again, over a long period of time, because venture is it's a long game where it takes a long time to figure out whether anybody is good or not. And it's hard to do that. I think that VCs will talk to potential partners for years sometimes before bringing somebody on.
When you think about the partners, that is kind of a peer. How do you think about building a firm in terms of junior partners or associates or other types of roles within a firm?
I think that it's tricky. There are certainly firms that build essentially they like bring up people from inside and they'll bring in associates and they'll elevate them and they'll train them. And I don't know that I would have the expertise how to do that. And so for me to bring on an associate feels tricky. I also think that like an associate's job is very, very difficult. They're like in some cases, they're like the SDR, like the sales development rep or a VC fund. They have to go and call a lot of founders and the founders don't want to answer the phone with them. They only want to talk to a partner. And it's a difficult role to succeed in. So for me and for my fund, I probably wouldn't do associates. I think I would bring on a partner that ideally would be equal to me, that I can just offload some of the responsibility to. And then at scale, maybe have like a 3-person partnership, no associates, no outside of maybe some folks to like help with back office and other analysis. But like on the investment side, I think it would just be an equal partnership. And I think the example there that I think of is Benchmark, right?
Why?
Whereas like I just don't think they have any associates there.
And so when you think about those small teams, is there something around consensus decision making versus the ability for any one partner to invest? I know some of these firms, even if they have 10 or less people, right? It's all consensus. In other firms, they're like, no, if you have a consensus decision by nature, it can't be a contrarian bet. And so therefore each individual partner can do a certain amount. Like, how do you think about decision making once you get past one person?
I think you have to allow for non-consensus decision making. There are some firms that are so good that they do even unanimous, it has to be a unanimous investment. And they're very successful. I think like some of the top funds in the world do it that way, but many, many funds don't succeed in that way. And in my mind, I think you, again, kind of going back to the point of you want someone that you trust implicitly. I mean, if you trust them implicitly, then you have to allow them to do a deal that you maybe would not have done yourself. And so I don't think you can do a consensus-based deal. You can give them all the reasons that you're like, sorry, I don't think you need, you don't want to do deals where like you all have to vote and, you have to have a majority approval to do the deal, especially like in a 2 to 3 person partnership. I think that what you want is you want a place where the partners feel free to voice their concerns and say, like, this is where I'm worried that things might go wrong, or this is where I'm worried about the space or something else. But if you want to do the deal and you believe in it, then I believe in you, and you're my partner, and like, go for it. That would be my ideal environment.
Talk about fundraising. When you go from a partner at YC, and you've got obviously the work at YC, but you also have your personal portfolio of angel investing, but you say, hey, I'm going to go out on my own. I'm going to raise a fund. I'm assuming a big portion of what LPs are underwriting is your past investments, but how do those conversations go in terms of them trying to underwrite you as a fund manager? You as someone who, yes, you have accountants, yes, you have fund admins, but you still have to manage those people. You still have to make these decisions. You still have to do portfolio construction. Like there are some things here now when you're using other people's money versus just personal angel investing that they want to understand. And so what was your experience like when you went out to raise that first fund?
Yeah, it's funny, So first of all, my timing with fundraising has been horrible for both funds. I started fundraising Fund One in March of 2020, so right as we hit the 1 month recession. I started raising Fund Two in April of 2022, so right as the market turned down. So I'll tell you when I raised Fund Three, because you should probably just go sell everything. So that certainly did not help, right? The other thing that I found surprising, honestly, people talk about VC, being an entrepreneur when you're a VC and you're starting a fund. But I can tell you that, like, as a past company founder, 99% of what you do as a founder is much harder than your day-to-day as a VC. The only thing that I think is harder as a VC is fundraising. And I did not expect that. And the reason is that, like, as a founder, you're generally looking for a market of one, or maybe a market of like 3 to 4 people who give you the money. If you're raising a Series A, that entire Series A is going to come from one investor. If you're raising a seed round, it's probably going to come from a handful of investors. But if you're raising a fund, it might come from 99 investors, right? That's your limit on how many investors you can have. And you may very well hit that limit. And so you need to go and convince dozens of people to come along for the ride with you. And most of the time, those people don't want to be more than like 10 to 20% of your fund. And by definition, they're more risk averse, right? These are not people like in venture. We're very used to risk. I'm very used to underwriting that it's either going to be a massive outcome or a zero. But these people are looking for outcomes that are going to be like, a great fund return is a 5x. That's like, honestly, top decile, right? Like top quartile fund performance, I think, is a 3x. Top decile is 5x. But like when you're investing in companies, you're looking for 50x's, right? And so the people that are underwriting funds are underwriting your past performance, your history, your everything. They really are like looking at you through a microscope. And I was not prepared for that on Fund One. It was a bit of a surprise. And so I do think that my past track record helped a lot. I think that, that my angel portfolio is deep enough and was representative enough of what I wanted to focus on as an investor that people were able to look at it and say, okay, that makes sense. The other thing that I did is I didn't try to go from like, writing 50K to 100K checks to all of a sudden writing $1 million checks. I was going from 50K checks to writing $250,000 checks or 350K checks. So the leap wasn't as big. Like investors could look at it and say, okay, you were writing similar enough size checks. We believe that you can continue doing that without adverse selection. But even then it was, I talked to hundreds of LPs and I got hundreds of rejections. And even now, I still get, like for Fund Two, I got a ton of rejections as well. And so it's a challenge. It's like, it's not easy. This is the only part of the job that's genuinely not easy. The other part of the job is you don't know if you're investing well, but that will take a longer time.
Why do you think rejections, like, can you bucket them into certain categories? Is it oh, it's a first time fund, I don't back first time funds? Is it your track record as a fund manager isn't there? I don't look at, angel portfolios. Like, what would you say went into some of those buckets, and less about like, what are the things that people wanted to pass on you for, and more so for people who want to go raise a fund, what are some of the things that they should be prepared for that maybe don't have anything to do with them specifically? It could be structural things,
Right.
could be kind of market condition things, anything like that.
Yeah, so I think that like in general, I take the approach of like hear the no, but not the why. So you get a million rejections and it's very difficult to figure out what the real reason is. But there are a number of rejections that I think are common for first-time managers. The solo GP thing is an issue for some funds. That's less of an issue today than it would have been like 5 years ago. But some funds like solo GPs, some funds will say we will never back a solo GP, even though the reality is that like partnerships blow up all the time, right? More likely to blow up a partnership than you are to blow up if you're solo. The fact that like a lot of people won't give you credit for your angel portfolio. They'll say, oh, you had like proprietary deal flow, or you had something else that maybe doesn't exist now. And so they're going to want to see it repeat. They want to make sure that you didn't just get lucky in that portfolio and you're able to do it again in your next portfolio and your next portfolio. A lot of people just won't do fund ones because they think that there's a big learning curve here and maybe you will never raise a fund two or fund three because you realize that this isn't for you. And so for a lot of institutional investors, they're looking at you not from I'm going to invest in your fund one. They're looking at you as I'm going to invest in your fund one, fund two, fund three, fund four, fund five. We're going to work with you for 20 years, right? And so it's worth it for them to wait 2 to 3 fund cycles, again, because there isn't that much of that FOMO of like, oh, I'm going to miss this like 50x outcome, and see how you're doing and come back and revisit this. So I try not to take those personally. So I think that like if you're trying to scale the check sizes, if as an angel you're writing 10K checks and now you're saying I'm going to write $500,000 checks, people are going to say, well, it's very easy to get a 10K check into a round. But once you're writing $500,000 check, you might actually be taking allocation from somebody else. And so prove to me that you're able to do that, right? And I think that like all of those are valid reasons. And you do in some ways need to earn the right to write those bigger checks. Like if I started in 2014 trying to write $500,000 checks, I would have gone in the worst companies. Right. So those I think are all good reasons. And those I think are the biggest real reasons that don't have to do with you personally. Oh, the other one, it's funny. I mean, people get very thematic. In 2020, everyone was asking me if how much of my fund is going to be crypto. In 2023 or 2022, everyone was asking me how much of my fund is going to be AI. And so LPs do sometimes end up chasing those themes and they'll say, oh, I am allocated on fintech, and I really want an AI fund. I personally believe that at seed, this is a mistake. You should focus on the people and let the people lead the way. I'm not a huge thematic investor. I think it makes sense at later stage, but probably less so at the early stage. But these are all like very valid reasons from an LP perspective.
Is there one major surprise since you started the fund that you kind of point to and said, I definitely did not expect this?
I think the biggest one was the fundraising. I don't know if there's like most of the other things, I think because I was angel investing for a while and I had a pretty long portfolio just on my angel side, like I'd done about 45, 50 angel investments before I started a fund. I was already familiar with a lot of the logistics there. I think that some of the, you just get surprised by like how much fund admin work there is. You think of it as, oh, I'm just going to go and invest and I'm going to work with founders. But a lot of your day ends up being spent on quarterly reports or on the financial statements or on the audit that your fund is undergoing, right? Or like the banking system is collapsing and you need to find banking partners. And so a lot of those things are, that it's not the stuff that you think about when you think that I'm going to go and work with founders and write checks to those founders.
That's great. My last question for you is, we talked earlier about reps and how important that is to getting better as an investor and kind of developing that pattern recognition. Is there anything else that you do to improve as an investor? Talk to people, read podcasts, like what else can you do to become a better investor?
You have to be incredibly curious, right? To be an investor, especially an early stage investor, you're trying to invest in the future. And so you have to have this like deep curiosity about what the future could be like. without prejudice, right? Like let people show you the future, meet them, and try and understand it from their eyes. And so I think that, you have to be willing to spend a lot of time with people. You have to read a lot. The reading can come in a variety of ways. You can read books, you can read podcasts, or sorry, you can listen to podcasts, you can read blog posts, where you could honestly curate a Twitter feed and learn a ton from that Twitter feed, because there's so many people now sharing their knowledge and their insights online for free. But fundamentally, you just have to be curious, right? And you have to be an optimist. You can't make money as a venture investor. You can make money in the public markets by being a pessimist, by shorting stocks and buying puts. But as an early stage investor, or a venture investor in general, you have to be optimistic about the future. And so those things, like that curiosity and optimism, you can't really you can't fake it. It has to come naturally to you, and you cultivate it by surrounding yourself with smart people.
I love it. Yuri, this has been absolutely fantastic. I really enjoyed talking to you, and I've learned a bunch in this conversation. Where can we send people to find you on the internet?
My Twitter is my first name, Yuri, and my last initial S, Yuris. And then the fund website is wayfinder.com. But honestly, I'm a solo GP, so my Twitter is probably a better place.
Awesome. Well, listen, thank you so much for taking the time to do this, and we'll definitely do it again in the future.
Awesome. Thank you. It was great.